Hey everybody, welcome to Founders 365 with me, Stephen Haggerty. Today I'm joined by the founder and CEO of Aquaa Partners, Paul Cuatrecasas. I'm hoping I nailed that one.
You got that right.
Close enough. Paul, thank you so much for coming on. Really appreciate your time. First and foremost, just let the viewers and listeners know what it is that you guys do over at Aquaa Partners.
Sure. Thanks for having me on, Stephen. At Aquaa Partners, we really have two core streams of business. One is we advise founders of tech companies, CEOs, management teams, shareholders, venture capital firms on how to achieve an exit, typically a trade sale or strategic exit, and advising them on that, or raising capital, which tends to be an institutional round, typically Series A, Series B, Series C. And then our other business, which we started back in 2017, is advising large non-tech corporates across all industries on how to find and acquire the right tech company in the right way so that they avoid being disrupted by tech companies. It can also accelerate their market value. And it's been a lot of fun and very interesting to have both pieces of that business growing at the same time.
And did they both get started at the same time?
No. We've been advising, we call it sell side. So the first business I mentioned, we call sell side. And we've been doing that, or I have certainly since 1993, based out of London. So our first client back in 93 was Fujitsu ICL, and we helped them on all kinds of things, but very often carving out some of their business units and selling those software or platform business units or subsidiary companies. And back then, of course, there weren't many tech companies. I couldn't tell you exactly how many there were.
It wasn't trendy back then.
We're talking, it was ICL Fujitsu, which was the big one. And we had companies like Scion, but maybe 50 to 100 legitimate tech companies. So we've been doing this really since the very early days in the UK and Europe. In the US, of course, you got to go back to the 80s, 70s because tech companies have been around there much longer. So we've been doing that. That's really the core business that I have been doing for nearly 30 years now.
Amazing. And I think an obvious question is, over 30 years, the M&A world has changed so much, I suspect. More recently, what have you seen some changes that's been going on that you perhaps didn't expect to see?
Well, that's an interesting question. I didn't expect that. I have to be honest.
Other than the whole COVID situation.
Yeah, no, I think that's right. We could carve that out as certainly a special situation. I actually didn't expect, and I can give an example here. I didn't expect that we would get to the point where we are today, which is that tech companies are growing so fast, exponentially fast, and infiltrating every industries to the point where even when we have the next market crash, whatever it may be due from, whether it's hyperinflation or a virus or whatever it might be, that it won't stop technology or technology companies. And I say that because back in 2002, 2003, I didn't feel the same way. So we had lived through and done well during the dot-com boom. We also did okay even during the dot-com crash. So, for example, one of the things we did was take, because there were no deals, frankly, in 2001, 2002, we took small stakes in up to 5% in quoted software companies, predominantly on the LSE. And we went to friendly private equity firms and family offices and said, look, these companies are trading at a very significant discount to their net cash value. So it would have been trading at, say a company trading at 20 million and would have had 40 million on its balance sheet, net cash. And so we created deals there. We actually did pretty well. And we also, during that time frame, advised Apax and Permira on the buyout of Inmarsat. So we actually did okay. But the long and the short of it was by 2003, I wasn't sure if tech was coming back.
Really? Wow.
Yeah. It was so bad for so long. We were spoiled a little bit in 2008, 2009, because in the credit crisis, we had a V curve. We bounced back, frankly, pretty quickly. Within a year and a half, the market was already roaring back due to interest rates coming down to zero, near zero. But the dot-com crash was a very long period of time. I mean, it was a 3-year period of nuclear winter. And it was so bad that I just didn't know if tech was coming back. Now, it turned out, of course, by 2004, 2005, it did. It was called Web 2.0. We sold Gumtree to eBay back in 2005. And I remember spending a week out in San Jose with Meg Whitman and the eBay team, strategy and M&A team. And it was like, wow, okay, it's back. You know, the web and the internet and the .com and all of that had not gone away. It was just preparing for the next run up. But the run up that I refer to now is one that has completely gone exponential.
Mm-hmm.
And I'd say prices at the moment are essentially priced for perfection for many of these big tech and quoted big tech companies. So that's a big question mark as to are the prices right, so to speak. And I would suspect that there will be a correction among the prices, but not necessarily at all with regard to the value of these companies, or at least the best companies. There are many companies that are going to fail, and they're going to have problems across the entire landscape. But in terms of tech and tech companies, you know, it is. There's no longer any question at all in my mind that this is it's not only the future, it's the only thing that there's going to be in 5 or 10 years' time.
Well, it seems that every startup you see now, whatever the face of it is, behind the scenes, it's classed as a tech company. They're trying to develop, they're trying to create new technology, like you said earlier, that is hopefully going to disrupt something so someone listens.
Yeah, and in fact, that's a point I made in my book. I actually published a book late last year called Go Tech or Go Extinct, around the theme of just what you said, which is that tech is infiltrating every industry. And that if today you wanted to set up a healthcare business, you wouldn't set up some traditional business that's focused on bricks and mortar nursing homes without it being absolutely fully technology enabled. If you were setting up a new bank, it wouldn't be a traditional bank. It would be a neobank, a fintech bank. And you're absolutely right. You can take that across any industry. In fact, I'd say that today, if you are starting up a software company, you've got to have AI built in from day one.
Yeah.
You're going to really struggle if you're trying to do software, whether it's cloud hosted or not, without AI and quality data built into the model.
But with every company, well, let's big generalization there, but with every company being so focused on tech now, is there a danger that it gets not too diluted? Isn't the right word, but it's how can we differentiate the successful tech versus the tech that isn't going to be there for much longer or is on its way out?
Well, I don't think we need to, because in general, because it sorts itself out. The market decides. The market always does decide. And one of Peter Thiel's better comments is that all failed companies fail because of competition, the lack of being able to compete. And there's always going to be customers taken away by your competition. And that's ultimately what determines success and failure. If you're an investor, then your question is very relevant, to a VC or an angel investor. Absolutely. If you are a startup company, I don't think it's relevant. I think if you're a startup company, or if you've raised angel money, or if you've done your Series A, then it's how do we continue to win? How do we continue to delight our customers or users and get traction and spread word of mouth and build a fan base of customers, users who love what we do, and keep doing that. And while you're doing that, of course, have your radar out for others who are penetrating your space, because maybe they notice what you're doing and they think they can make it better. It's why Andy Grove, who was on the cover of Time magazine at the end of his career, who grew Intel's market cap from $5 billion to $200 billion, which back then was a big deal. It's why he said only the paranoid survive. It's why Doug McMillon, CEO of Walmart, when he acquired Jet.com and went on to acquire many other digital brands, said, look, he said this last year, we could be gone overnight. Saying the same thing. And it's why Jeff Bezos says it's always day one at Amazon. It is the exact same mentality among the most successful entrepreneurs, which is, we know how vulnerable we are. Google renamed themselves to Alphabet because they know they're, by definition, vulnerable, with 95% of their profits coming from the Google and YouTube search engines. So all great companies, whether it's day one, day 10, or day 10,010, know how vulnerable they are in tech, because everything moves so fast, and because good entrepreneurs are very good at what they do. And
100%. How do you take that? How do you take that thinking and absorb that into your own business then, for you personally?
For me personally,
Yeah.
that's a great question. It's easier said than done, isn't it?
Always.
It's easy to be the armchair quarterback and give off tons of advice without doing it yourself. I think it's like any other journey that most entrepreneurs have. I mean, entrepreneurs go through a journey, and entrepreneurs have ups and downs. I struggle to think of an entrepreneur that's successful today that had not had some up and down. If they haven't had their down yet, then it's just a matter of time before they have their down. I would say for 99 out of 100.
Well, it's that classic. You must have seen it. That entrepreneurial graph that you start there, you think you're doing great. Oh no, I'm failing. The next day, you think you're doing amazing. Next day again, oh, I'm failing again. It's a lifestyle that very few would actually have the choice of doing if they knew what it would be.
I think it's a really good question. It's so appropriate and relevant for every entrepreneur, and it's interesting you asked me, and I'm always learning. It's one thing. It's one reason why I like to be an entrepreneur is that I'm always learning. It forces you to learn and stay sharp and keep the mind and body sharp. You just have to be. You cannot be. You can't take your foot off the gas. So you must remain sharp and you must remain active, and you have to have energy. And I think having all those things helps, frankly, make life a little bit more interesting. And if you have the right attitude about it and the right mindset that it's about growth and that, every problem doesn't need to be seen as a problem. It's just another moment in life to be tackled and captured and seized. And I think that's the attitude. And I'd also say that if there's one thing that it's taken me a long time to learn, and by the way, sometimes we learn things and we forget them. I was going to say it's people. So in my first firm, we had just wonderful, amazing chemistry among the partners and among the juniors and among the whole company. And it was magical, really. And sometimes, you got to find a way to assess and explore how do we create magic in our culture among the people so that it's everywhere and so that the dots that we're connecting as employees in the company can project their own strength and warmth and value onto the ecosystem of customers and suppliers, candidates, and partners. I think that's really important. It's incredibly soft and tangible, a cultural thing, but it may be the most powerful thing of all. And it's the hardest thing to create. And it's only recently that I kind of decided that one of the first hires that startups should make, and they should make it early and earlier than they think, is a human resources manager or a talent management director. Absolutely, because people are everything. They're everything in professional services, which is a little more obvious because it's the ideas and how we execute the ideas, their action. But software and tech, it's the same thing. It's people with ideas that are coding those ideas into software or designing them into chips or into platforms and systems. But it's the same thing. It's people who are doing that. It's a little bit different than having an established stapler company that's been around for 100 years. And, every year you're able to make a stapler in a new design, a new color, and a slightly different weight. And maybe you can price it differently. And maybe the staples themselves have a new material. Not quite the same, that example. But with tech, it's people. And so.
Well, you can see that when you just go into a tech office, their whole office setup is completely different to those more traditional businesses because they're people orientated, they're focused. Even from the snacks they give to the way they set up their co-working desks, everything is designed to make the staff within one, stay there for as long as possible, let's face it, and two, enjoy being there. You mentioned Google earlier. They're a pioneer on the whole, actually, let's make our space as staff friendly as possible.
But I think that starts with cause and effect. So I think cause, the core reason why Google engineers, data scientists, and other employees are attracted to Google is because of the intensity of their mission, the fact they want to remain number one, be the best. They're exploring, they're experimenting, and yes, they offer the famous 20% of an engineer's time to do their own thing, but of course on Google's behalf. So that's the core of it. And as long as you've got the best people who are the right fit for that intense mission, then you can say, okay, let's have a free cafeteria, free lunch where they can go and have the ping pong tables. It's not the other way around. I mean, I think there's a lot of misunderstanding in the general business community around just what you described, the tech company atmosphere, the WeWork type atmosphere.
Mm-hmm.
It's not about, well, I'm going to go work for a company that's got free beer and shrimp and lets me play ping pong at 3 p.m. at lunch. It's not about that. That happens to be a coincidence, frankly, with the type of people who are working there, who are free, and
yeah. But with that in mind, how do you think tech companies are going to be changing the way they're working because of what's happened in the last couple of months, if anywhere?
I don't think they'll change a lot. So tech companies have already been working remotely to a large degree. I mean, look at GitHub, which was sold to Microsoft, I think, for over $7 billion. It was an entirely remote company. There are already many, I can't tell you how many, but thousands and thousands of companies who are doing very well that have already been remotely working 100%. This is just a personal expectation. I wouldn't be surprised to see this over the next couple of years. I wouldn't be surprised to see more existing companies and new companies that are starting up virtually, which if you're starting a company today, it's almost certainly going to be virtual. But I wouldn't be surprised to see, and we're thinking about this, by the way, even for our own company, believe it or not, there's a possibility to see employees that are working remotely for a large part of the time, but they all come together at certain points in time during the year, maybe once a month, or a day or 2 days or 3 days, or maybe it's even once a quarter. And they come together in a way that's different from how you turn up every day in the office. So you're coming together to, yes, talk strategy and yes, talk tactics and operations, but also to bond and to have some fun and to kind of learn about who the people are who you're working with, so that you actually have a bit of a bond emotionally. And so when you go back to work behind the screen, it's a different kind of screen experience. And I wouldn't be surprised to see more of that. And by the way, by doing that, companies do not need the large office space they have. What they will need is a place to meet once a month for 2 or 3 days, or once a quarter. Maybe that's a hotel or a resort or something like that. So companies can reduce costs, can increase the bonding and the connection with each other, probably increase the productivity, while people at home are now. Not everybody can work from home.
I think a lot, those people that didn't think they could have adjusted to be able to. It's funny you say that, because I've said pretty much the exact same thing, that I think there's a really good opportunity in the future now, probably like you said, in this 12 to 18 months, for commercial property to shift away from the let's sell office space to let's sell space where you can bring your team once a week, once a month, once a quarter, and everything in there is set up so that your team are bonding, whether that's through activities or whether that's just once a week you come and work here as a team, but it's not in that sterilized office environment. I would be very surprised if places like WeWork, Regis, all those kind of places don't start offering some sort of that service in the format. If they don't, I mean, they're missing a trick. And I know there's a few smaller co-working spaces that are popping up, sort of independently owned, that are already switching to have that sort of offering on the cards, because it's going to be needed, right? There's so many empty offices now which just won't be ever used again.
Yeah, I agree.
For you, Paul, where's the opportunity next, right? Where do you predict, like we just said, this commercial property has that opportunity coming up, but for the tech side and for M&A sides, what's going to be happening in the next 12 months? Because from where I'm standing, it's just going to be a really interesting time. So from where you're sitting, really in amongst it all, you must see some really cool stuff happening.
Yeah, well, we're already seeing deals in the last 2 or 3 months that are happening as a result of the pandemic. So in May, Compass Group, which is one of the world's largest caterers to offices and office buildings in terms of the food and the canteen, cafeteria, they acquired a small company called Feeder, F-E-E-D-R, for $24 million. That was essentially a food delivery company, but is a food delivery company, delivering meals to employees in offices. And they Feeder pivoted immediately after the lockdown to be able to deliver that food to employees at their homes. And then Compass Group acquired the company. as I said, for 24 million. And interestingly, there was quite a bump up in the Compass share price. In fact, in terms of market value, after I think about 5 to 10 days after the deal was announced, the Compass Group relative to the FTSE 100 had added about $1.5 billion
Wow.
to their market value on a $24 million acquisition. Just a reflection that the market liked the deal and believed that there's a lot of promise for Compass to be able to transform its entire operations over the next 5-10 years from new models that are emerging like feeder.
Mhm.
And then it was last month, I think in June, when Lululemon, the maker of women's clothing, yoga, and so on, acquired a company called Mirror, which is a little bit like Peloton, but it's a mirror on the wall that's interactive, and you can do classes in boxing and so on with others. And that was also a very interesting deal in which the Lululemon share price had a similar effect after announcing it, because you can see some obvious synergies with the businesses. And also during a pandemic, during a lockdown, people are having to work out at home. So we've already seen some very interesting deals by non-tech companies acquiring tech companies. I think we're going to see a few more across the general tech landscape. There's no doubt that AI, big data, cloud, software hosted on the cloud, SaaS, across, frankly, all applications are going to be extremely interesting over the next, from now until the end of time, but certainly starting now. The problem from an M&A perspective is, at the moment, there is still a generally accepted belief that prices are too high.
Mm-hmm.
And I do advise companies to take that with a grain of salt, because looking at Tesla and looking at Lemonade doesn't necessarily mean that that type of price dynamic applies to every single good tech company, regardless of size. Every company is different. And there are thousands of extremely valuable tech companies that, by the way, are doing AI, data analytics, and hosting and so on everywhere throughout the world, that don't have anything in terms of the shareholders and founders don't have anything like those kind of price expectations. So while price, I think, is holding back a lot of otherwise would-be acquirers, it shouldn't be. There's nothing wrong with preparing a crash list now, because I think, personal view, it's inevitable that we're going to have a major correction in the tech sector. Whether you want to call it a crash or not, we'll have to see. But could prices fall by 50%? Of course they could. Yeah. It's happened before. It's probably going to happen again. There's nothing wrong with that. And I think that's important.
When things like that happen, people, a lot of people, let's say, go into fear mode. Mm-hmm. But if you look back into the history, it's just a pattern. It's something that always crops up at certain points of time, and it's fine.
You have to plan for it, like anything else. If you're an entrepreneur, you absolutely have to plan for that. And frankly, you're being irresponsible if you're not. Mm-hmm. I know entrepreneurs who have not planned for it. They've raised some cases $500,000 to £1 million a month on the basis that the money's always going to be there. That is irresponsible.
Yeah, super naive.
It's some entrepreneurs will tell you, well, they didn't feel like they had a choice, or they're just trying to patch up to the next, or bridge to the next month or next quarter, because that order is going to come through. The order that we've been told will be signed is coming through, but it very often doesn't. So the responsible thing to do is raise a little bit more cash than you think you need, and always be cognizant of the fact that when the market crashes or corrects and prices of tech companies correct, there's a ricochet effect throughout the entire ecosystem. And importantly, if you have venture capital investors, they may not be as willing to support you as some of their other portfolio companies, despite whatever you're being told and whatever you may believe. They may not be as willing to support you when the market bottom falls out. And if they're not going to support you, you're playing with fire if you're assuming other VCs will come in and invest. You will find that you may have the lenders and investors of last resort who come in, who not only look at a down round, but look at things that you'd rather not contemplate. And the way that you deal with that is months in advance of it actually happening, by planning. It doesn't need to be called a plan B. It should still be part of your plan A. All it is really planning through market cycles. The other thing that happens is it isn't just the raising of capital and the valuation and where you're going to source your capital. It's your core business. It's your revenue. If you're B2B, then you need to see to what extent is your business depending on contracts, both the ones you currently have, which ones could be canceled, likely will be canceled, and which contracts will you not win? How does it affect cash? How does it affect how you manage your business? B2C, if it's anything advertising based, that's a big problem. I mean, these are obvious things, right? I mean, in a market downturn, advertising is travel, entertainment, and so on. Even now in the pandemic, it's the first thing that companies cut.
Yeah.
So this should just be part of the natural planning process. And it's why I say when we have a market crash, it really shouldn't be a big deal for anyone who's been responsible and has been planning for that to happen. So at any time, so that they can adapt and adjust. And it's like, oh, okay, so we've had a crash. And to not get distracted with all the noise. And because that's what there is. It's just all you hear about in the news, and it's just noise.
Whose responsibility is it to prep that? Do you think it's the founder's responsibility as the founder of the business? Or do you think some responsibility should also lie on, if they're investor backed, for the investors to protect their investment?
Both, 100% both. So all entrepreneurs that have moved ideally beyond they're either in angel stage or beyond angel stage, you have a board. Even if it's only 3 people on the board, they should have a board. And the board's response, and especially when you have a VC on your board, when you get to that point, the board's responsibility for sure is to remind that management team early and often that don't take anything for granted. Don't take anything for granted. Don't take the markets for granted. Don't take your valuation for granted. Don't take the fact that you've raised $1 million or 10 million from us for granted. Don't take the fact that you've got a great CTO who just joined you for granted, because that CTO might leave. You know, don't take anything. So that's the board responsibility, is not just to help with planning and to help with recruiting and to help with sourcing capital and strategic partnerships and channel relationships and possible customers and other introductions. Yes, but it's absolutely the responsibility to constantly remind management to not take anything for granted. Anything can happen at any time. Always be prepared. Management should also have, I'll tell you what I tell entrepreneurs, and I think it's probably a little bit unusual, but my advice to entrepreneurs who are looking to raise capital, whether it's $500,000 from an angel or whether it's 20 million in the Series B, is try to think of yourself as a risk manager. Now, I know it sounds crazy for an entrepreneur who's out there wanting to change the world and wants to be the next Steve Jobs or Jeff Bezos, but try to think yourself as a risk manager. If you're taking someone else's money, then you must respect that money as theirs. And all you're doing is acting as a caretaker for their money for a period of time. And you are managing the risk attached to their capital. Because it's gone into your bank account and you're using it, doesn't mean it's yours. It really isn't. The company is yours. The people, everything you're trying to do and changing the world is about you, but the money is theirs. So when you're first talking to investors, talk to them in the context of also being a risk manager. Make it clear to them and be sure that they understand you when you say, understand this is your money and you want it back. And we know that you want a return with that. We're very clear about that. We're 100% clear. We know you want it back. We know you may want it back in 3 years rather than 7. So we will respect that. And we consider ourselves risk managers of your capital. And very few entrepreneurs will ever say or think anything like that. But if they can be genuine about it, so often it takes time to think in and concentrate.
So it's a really great way to phrase it to them.
If they can be genuine about it, then investors will flock, all else being equal, to those entrepreneurs. Because one of the greatest frustrations that VCs have is, this is a great entrepreneur. I mean, they're out, beating a path to everyone's door with this new product solution, recruiting great people, but they're so in their own head. They have such a stubborn view of many things, and in many cases they're right, that I'm a little nervous they won't realize that the money we've just, whatever number of millions we just invested in this business, they'll forget that it's ours, and that they're only doing what they're doing because of the capital that we invested in them. And so it really is a great frustration that investors have, that they're sometimes worried about that. I think sometimes it kills deals because the entrepreneurs don't listen. And they don't.
Founders, entrepreneurs often forget that investors are looking at them when they're speaking to them. They're not necessarily always looking at the product or the tech. They're looking at the people that are running it, that has the idea, that has the passion. Like the tech and the product's only going to get you so far.
That's right. 100% right. Yes, it's one of the things I've learned, or have come to believe anyway, after my 30 years of doing this, and I have lots of scars to tell the tales of being through many battles, is that it's really all about the people, right? It's, yes, we want to be sure that you've built a product or solution that can win in a large market, that can go beyond the corner shop and be in 60 countries within 24 months. Yes, of course. But before that, it's about the people. It's about the founders and the people that they've recruited. And there's, the vast majority of the investment decision is based on that, because really good people can, frankly, make anything happen. They might make a mistake from time to time.
Sure.
Really good entrepreneurs and teams can do almost anything. They can course correct very quickly, pivot, whatever word you want to use, very quickly on a dime into the right direction. The ones who don't tend to be a bit more stubborn. They're very difficult to work with, and they may have built the best mousetrap, but frankly, the chances of succeeding, especially today when everything's moving incredibly fast, are low. And investors know that. By now they've learned that it's really all about the people.
And this is why you see investors follow founders through multiple different products, businesses, packages, all that kind of stuff. So people overcomplicate things, but like you just said, it is really simple. It's people business. Like you often hear about there's no B2C, there's no B2B, it's just P2P. I'm a firm believer in that, and definitely. One thing I wanted to ask you before we finish this off, and it's quite a big question, so I've probably left it a little bit too late, but what is your view on those businesses that are sort of like very heavily invested into, but I would say sort of like they're no money generating businesses, but they're just keep getting pumped into investment, and they're almost too big to fail? What's your view on those?
I'm not sure about too big to fail. WorldCom failed. WeWork. I mean, we could name many that failed.
Oh, WeWork, right?
But I understand but you're right. I mean, there is that element. I understand the question. Look, the best answer is, I think, everything is relative, and every company is different and has its own DNA in the same way that every human being is different, and we all have our own DNA. So there are some companies that have that right mix of entrepreneurs and teams and vision and ability to execute and do whatever it takes to execute on that mission, that you have to trust that they will do it. And we all know some names of entrepreneurs that have done that, like Jeff Bezos and Elon Musk. So there is a case to be made for that, but it is risky. And I think what you're really getting at is that, it's a complaint that many participants in the VC and early stage company ecosystem have, is that a lot of these companies do not have attractive unit economics, and you struggle to see how the lifetime value of a customer is going to be worth the customer acquisition cost. And I think that's where it gets interesting, because we humans think in a linear way, and we can be short-sighted in so many ways. And very often we take for granted the network effect and the fact that in a year and 2 years time, 3 years time, we're going to have new technologies. 5G is a big part of that, but VR, AR, holograms. There are going to be ways of adjusting the formula and the ratio of the LTV to the CAC that maybe we don't always see or we don't always understand. So I'm not saying that is the reason to assume that these companies should exist. It's just the reason why maybe they do. Sometimes it's the founder. Sometimes it's the belief that the investor has based on the investor's own experience, combined with the entrepreneur's experience and vision and values and ability to execute based on a track record, that says, you know what, we're okay to burn cash for 5 years because we have an extremely high level of confidence that as we're burning cash, this team is going to constantly pivot into the direction where they are constantly accumulating value. They're accumulating love from the users and customers that they do have. They're accumulating this word that's spreading, and we're going to convert. We're going to monetize that love from the customers into a business model that's going to work and it's going to scale. At the end of the day, most of these companies have to scale quite dramatically, or it doesn't work. So that's the obvious answer as well. They're going to have to scale, but it's easier said than done. I think the answer is more about what I said earlier. It's about the team and how, we know there's, Seth Godin had a good, I read his emails very frequently, the daily emails. He had a good one a couple of weeks ago that said, there's very few things in the world today that are great, that have been built without a great idea. But that great idea has to go through 100 different iterations before it ends up being executed or fully formed. And most people give up along the way because they can't stand the pain, the difficulty, the gut and the blood and the tears that have to be sweat, and experienced on the way from step 0 to step 100. But those special teams that tell an investor right up front, I'm going to go from step 0 to 100, no matter how many tears I shed, how much sweat and how much I bleed. It just doesn't matter. As I climb the mountain, I'm going to swat the mosquitoes off me. And you can believe me because I've done it twice before. I've done it before. It's who I am. And that's what I do. And I'm looking for an investor who believes in that and is with me all the way. And and that's the answer. And I think, if I were in a position of having to make that judgment of, do we commit 100 or 500 million to a company on the basis that they're going to burn cash for 3 or 4 or 5 years before they can scale and become the next $1.5 trillion Amazon? That's how you have to look at it. And that's as much as a psychologist exercise and psychometric testing and so on as it is anything else.
No, perfectly put. Paul, listen, thank you so much for coming on. I feel like we could probably talk for a long, long time and dive into a lot more holes, and I'd thoroughly enjoy that. But unfortunately, we don't have the time. But Paul, my final question is, how can people find out more about you? How can people find more about Aquaa Partners?
Well, they can just they can Google my name, Paul Cuatrecasas, or my firm Aquaa Partners, AQUAA-partners.com, or my book on Amazon, Go Tech or Go Extinct.
Lovely. I love that title, by the way. It's fantastic. Great.
Paul,
thank you so much for coming on Founders 365. Like I said, thoroughly enjoyed it, and you're a man of wisdom.
Thank you, Stephen. Enjoyed it.
Thanks everyone for listening and watching. This has been Founders 365.